What's up, everyone? It's Karthik with MoneyVest. Welcome on board for our CPI inflation live stream. Hope you all are doing great and are having a great week so far, even though we have seen some significant sell-offs in technology and software and AI names, as there's been some increased fears, some more elevated fears regards to AI. So we do have CPI numbers coming out in under 30 minutes. So at 8:30 a.m. Eastern, we will have the numbers for inflation coming out for the month of January. So we're going to take a look at those numbers and see how the markets actually react, because we are seeing some extended sell-off from yesterday's pullback. So NASDAQ 100 QQQs are down another 18-20 basis points. They were down over 2% yesterday, as we saw almost $1 trillion wipeout from the S&P 500, which was down a little bit over 1.5%, selling off another 20 basis points. Robinhood was down over 8% here on Thursday. Nvidia was down over 1.6, selling off another 18 basis points in pre-market trading at the moment. So if you come over to the watch list in pre-market trading, again, we do have substantial amounts of selling pressure with Palantir. SoFi is down over 1.3%, trading down to low 19s. We got ASML, Tesla, Amazon, Broadcom, Google, Apple, the list goes on and on. Everything is down anywhere from 0.5% to as much as 1.5%, as we see a little bit of that continuation from yesterday's pullback. And the NASDAQ 100's MoneyVest Index sitting down at neutral at just over 3 right now, 3.07. And the S&P 500's MoneyVest Index is sitting now back in neutral at under 3.5. It was trading up to optimism at 3.6, 3.7, and then coming back down over the last day back to neutral here at under 3.5. So if the audio and the video is good, just give me a thumbs up. Just want to make sure there are no technical issues here, and I'm happy to go over any questions, all the different questions related to fundamental analysis, options trading, technicals, psychology, whatever, all the Q&A. That's what we're going to be doing for the next hour. So any questions, let me know, and we'll take a look. So this is going to be the CPI report, expected to come out in, like I said, in 30 minutes. And if we take a look at the consensus right now, it is 0.3% for month over month. Year over year expected at 2.5%, so expected to come down from 2.7 down to 2.5. And ex food and energy, so core inflation expected to increase by 0.3% month over month, and year over year expected to come down also from highs of 2.6 to 2.5%. So that is what we are expecting from inflation. So good morning, MoneyVest community. And let's see, CPI. That's a good one, Jay. It's not going to be CPI. It's going to be CPI. I like that. I hope it's 2.3. Low CPI, IGV, Bitcoin, and fintech and AI will rise. So if inflation comes in obviously below expectations, that is going to be a signal for the market, a little bit more of a bullish, optimistic signal. But of course, if it comes in hotter than where the expectations are, we're back to trying to understand what is the Federal Reserve going to do with interest rates later this year. Because, if you come over to the CME FedWatch tool, right now the market is pricing in for 2 more rate cuts in 2026. And then if you take a look at the Federal Reserve's own summary of economic projections, if you come over to meeting and calendars, we did not get a SEP, the summary of economic projections, in the January meeting, but we did get one towards the end of last year. So this was December 10th, is the last time we actually got the projection materials released on December 10th, 2025. So this was the last summary of economic projections that we got. And you'll notice that from 2025 to 2026, the Federal Reserve was only pricing in for 1 rate cut. So 1 rate cut is what they were telling us. So 2025 to 2026, they're expecting only 1 rate cut as per their own projections. And then the market right now, of course, is pricing in for 2. The first one coming in June, and then the second one coming in September. June more so because Kevin Warsh is most likely going to take over. He's the leading candidate to succeed Chairman Jerome Powell after his term ends in May. And I'm sure President Trump is going to be very happy that he's gone, because there's been a lot of conflict, a lot of feud between the chairman of the Fed and, of course, the president of the U.S. And that has created another whole level of uncertainty between the U.S. government and the central bank in the U.S. So once Kevin Warsh potentially takes over, then the market's expecting for the first rate cut and then another rate cut in September, as opposed to what the Federal Reserve themselves have told us for back in December for only one rate cut. But really, inflation is going to be the guiding point, as well as the labor market, to really understand what is the Federal Reserve's motive with interest rates moving forward, because that is a very, very important tool that they are going to be using. But I can tell you from my own experience, and in fact, there was a conference here in Dubai earlier this week on Monday. So I actually went to this conference earlier in the week where there was an economist from Emirates NBD from their entire Middle East region. And they mentioned in that presentation, in that conference, that most of the banks are pricing in for 2 rate cuts for this year. So all their models are built on another 50 basis point rate cut from the central bank in the US for 2026. So any kind of variance there, if there's 1 rate cut or 3 rate cuts, that's really what's going to dictate market direction moving forward. And for the last couple of weeks, though, we have really seen the market stabilize, consolidate, and be very, very range bound. So we haven't seen a breakout or a breakdown. The market's just been bouncing in between that range as it tries to figure out AI, tariffs, geopolitical uncertainty, monetary policy uncertainty, interest rate directions, inflation and labor market, and all of those reports coming out, as well as earnings. So there is definitely a lot to consider. Not to mention the market's rotation and the positioning that has shifted away from AI, away from software, away from tech, over to more safe haven assets. And commodities are still leading this market higher as gold and silver continue to push up. Year to date, they're still up 15 to 7% respectively, gold and silver, and cryptos are still struggling. They're down 25 to 35% on the year so far for Bitcoin and Ether. So Kevin, thank you so much for that. I really appreciate it, and I'm sure a lot of our members do. Thank you for gifting some memberships there. We really appreciate you. And let's go over some of the comments here. Good morning, everybody. I don't care if it's cooked. We need this market to recover, is what Steve says. You know, the market hasn't really dropped all that much for it to recover, because we're still, for the S&P 500, so if you were to put things in context, the S&P 500 is very close to the all-time highs. I mean, it is only down 2.4%, which is nothing, right? Which is quite literally nothing. The Nasdaq obviously is down way more than the S&P. It's down a little bit over 5.9, almost 6%. But in real terms, you know, for a lot of our members who've been part of the market, who've been investing for many, many years, we understand that 2%, 3%, 5%, 6% is nothing compared to what we have seen and how bad it could actually get. So, you know, even though, yes, our portfolios are hurting because if you are tech focused, if you are software and AI and growth stocks, primarily, you are feeling more of that pain as opposed to somebody who's investing in Dow Jones or more value and dividend stocks and staples and financials. So that's really how market positioning works, because growth stocks are definitely hurting more than value investors. But at the same time, it's both ways. On the way up as well, we feel the gains more than the value names, right? So volatility is the price for market participation. And depending on what sector and what area of the market you're participating in, that determines how volatile your portfolio will be. So, you know, that's really what we're dealing with. And again, this is not a substantial loss. This is a very, very normal pullback for the S&P 500. I've gone over many spreadsheets in my previous updates. You know, plenty of times I've gone over this specific spreadsheet, which I think is one of the most useful ones, at least for me, going back over 50 years of data. And what this shows us is very simply, you know, when markets are down from all-time highs, what is the percentage of times we've actually seen the markets down more than that threshold? So for example, a dip, 0 to 5%. 40% of the times in the last 51 years, the markets have spent between 0 and 5% from all-time highs. A pullback, which is over 5% but less than 10%. That's 16.5% of the times. A correction, over 10% down but less than 20% down from all-time highs. That's another 21%. So if you add up these first three values, that comes up to over 78.24%. So what does that number actually signify? That means that the markets, S&P 500, have spent 78% of the last 51 years, less than 20% down from all-time highs. So that is a pretty substantial statistic, and it jumps to over 92% for less than 30%. So that's why if we ever get to a bear market of over 20% and volatility gets up to over 50 or 60, that is one of the best signals from a risk reward standpoint. That is what I've dissected, looking at all of this data, studying all of this spreadsheets, is I've dissected it down that if you catch the S&P down over 20 and volatility in its 90th percentile or higher, and the money vest index is under 2.5 or 2, that's it. The risk reward is fantastic. You better be deploying capital in that market. So that's where we are. And yes, Kevin says, bring on more pain. I want coupons. And that's what we love here at MoneyVest on this channel, is coupons and deals and discount. I 100% agree. And I think a lot of our members kind of share that similar mindset. And you know, in the beginning, it is quite challenging to kind of recondition your mind and psychology behind investing, but that's really what it is. Red is good. Discounts and deals are amazing and always appreciated in the market. So coming back over to inflation, again, for people who are joining us now, inflation numbers, so CPI is going to be coming out very soon in about 13 minutes. So inflation numbers are scheduled for today, and that's going to be for the month of January. And we're going to take a look at those numbers and see how the markets react, whether these are the real numbers or cooked numbers or whatever you want to call it. But this is all we have. So we're going to come over to Trueflation as well. And take a look at the inflation numbers here. So let me see. Inflation calculator. Let's see. Start calculating. And okay. Trueflation. Let's see. Trueflation indexes. There we go. Okay. So Trueflation US CPI inflation index 0.72% is what they are. I got to sign up and stuff. Okay, I'll just do that later. But yeah, Trueflation has also, I think, missed expectations in the past for what they are reporting versus where the actual numbers end up being. But overall, you know, 2026, the Federal Reserve themselves are expecting CPI or PCE, personal consumption expenditure, to be sitting at 2.6%. So they're actually expecting for it to be a little bit higher, or 2.4%. 2.4% is the updated number, and the expectations for today are at 2.5. For core, they were expecting 2.5, and that's exactly where the expectations are for today. Ex-food and energy at 2.5 for CPI. So yeah, let's get ready here. Thanks, Kevin. The truth shall set you free in 2026 till infinity. With SoFi and Palantir, I'm down at least 50,000 pounds this year, long-term hold. Market says, yeah, I mean, you know, some years stocks are going to sell off, right? That's the volatility of the market. The last 3 years have been phenomenal, right? You know, if you consider how stocks have gone up in the last 3 years, the markets have been very generous. And we even did this analysis on a 3-year streak. Let me see if I can pull that up. If I have that spreadsheet, there we go. So this is the spreadsheet that I, you know, mentioned in my previous videos. And if you take a look at this spreadsheet, which calculates the yearly return, the annual return of the S&P 500, the last 3 years, take a look at this. 2023, 24% return. 2024, 23% return. 2025, 16.4% return. So if you consider the total return since the end of 2022, we are looking at this number at around 178. Let me just do this very quickly. So minus, and then I'm going to divide this by this number here. We're looking at 78%, right? So 78% gain for the S&P over the last 3 years. And annualized, it is double digits on all 3 years, right? 24, 23, and 16. And that is no joke. That is not an easy thing to do. I think we all have to appreciate how crazy this market rally has been since the bear market of 2022 and how much the portfolios have grown. But oftentimes we will see those corrections, we will see those dips, we will see those pullbacks. It's all part of the market cycle, and nothing can keep going up forever. And it's nothing but a pendulum. It swings from far greed to far panic to, and again, fear, uncertainty to getting back to euphoria and hype once again. So it's a pendulum that keeps on swinging, and we just have to deploy capital when the risk reward is extremely good. And if you go back, the last time you saw that streak was in 2019. So 2019, 2020, and 2021, we saw double-digit gains for 3 years in a row. And then 2022, the markets were down over 19%. And then prior to that, once again, we saw that in 2012, 2013, 2014, and then we broke that streak in 2015 again. The last time we actually saw 4 years in a row for the markets to be pushing higher by double digits was back in the 1990s, right before the dot-com bubble bursting. 1995, 96, 97, 98, 99. That's why the saying goes, party like it's 99, because we saw 5 years of extreme gains from the market. And then, of course, 3 years of brutal selling pressure, the tech bubble bursting, stocks down 80 to 90%. So those are the market cycles that we always have to be aware of. So yeah, quick note on that. And then coming back over to some of the comments with 9 minutes left to go for inflation numbers scheduled at 8:30 a.m. Eastern. Yeah, Kevin, gift again. It's hard to understand why both AI stocks and software are being punished. If AI will eat up software, at least stocks like Nvidia should stay up. Yeah, I think semiconductors are getting sold off with a bit of an overreaction, especially what I discussed in my Google video as well, because, Google kind of set the precedent, and they also set up an example of what companies could potentially do is set up these large corporate bonds, in other words, 100-year long, which is a very rare century bond, and they can raise capital. But there was also a very indirect message from Google coming in that if they're financing for the next 100 years at 6%, they certainly do think that interest rates are headed higher. They do think that interest rates in the long term are going to be trending upwards, and they're going to be locking in a much lower interest rates. In other words, in hindsight, 20 years from now, this rate might actually look quite reasonable and quite cheap if interest rates do trend upwards. Because if that was not the case, if they were expecting rates to be lower, they would much rather use their own capital to create that arbitrage, because the company's got plenty of cash flow. They do have a ton of cash on their balance sheet, but they also want to keep that invested or find that for other higher yielding opportunities. And they do, again, expect the cost of borrowing to be higher than 6%, and then their investment on the cash that they already have to be much higher than 6%, because that's where the arbitrage really comes in. Because there are really two messages they're sending us. One is the cost of borrowing could potentially be higher long term, and second, which is the uncertainty piece, is that whatever they are investing in data centers in AI is going to yield a much higher rate of return. So in other words, their return on invested capital needs to be over and above 6% in order for this to actually make sense. Because why else would you borrow $30 billion at 6% if you don't think that invested capital is going to generate at least 10, 12, 15% long term with the spend that they're going to have. So yeah, I think it's a very untested waters for sure. This entire AI landscape, but semiconductors, in my opinion, are still the indirect beneficiaries in a long term, in a big way, and that's one of the reasons why I think SMH is for me a buy and hold long term. I will consider dollar cost average into that ETF. Okay, starting my weekly DC809 QQQM and VOO. That's amazing. I don't want any more discounts on HIMS. HIMS has been struggling left and right. I think there was another report that the US government is now going to step in and fine HIMS and HERS for their brief launch of their Vega V copy of the compounded version of the GLP-1 pill, which again they were sued from Novo Nordisk. My portfolio is VTI, SMH, VB, and NUCG. That's all. What do you think about my portfolio? Thank you. I think those are all pretty good ETFs. I think that's pretty diversified. Vanguard funds, you've got semiconductors in there. I think overall it is pretty solid. Again, depending on how much time and how active you want to be, you can layer in some individual stocks on top of that as well. But that is a good foundation for the market. Where market's always this crazy, talking about 3% intraday NASDAQ swings and solid earnings reports, seeing stocks dip double digits. Yeah, I think the markets have been volatile. I mean, it's normal. For us to see a 2 to 3% swing for the NASDAQ, it has become normal. Because of the leadership, you also have to look at the market concentration, right? I mean, 20 years ago, we did not have such high levels of concentration in just such a small amount of stocks. And these are not like your, low beta stocks. If you come over to market concentration, so we created this page, why? So that we can track down the exact weight for individual stocks. You can actually create your own indexes on this page. If you come over to S&P 500 constituents, it has all the 500 companies listed over here. Now, if you want to specifically talk about certain stocks, if you want to look at, okay, how much is PayPal worth plus, let me just go back a little bit. So in S&P 500 constituents, if you select PayPal, and then you can select maybe another stock over here. You want to look at AMD, you can select another stock. So it's going to show you, how many stocks you've selected and what is the overall weight of those companies in the S&P 500. And of course, their change and everything, all of that as well. So over here, you can see the Max 7 has a 33% weight. So a third of the S&P 500 is made up from just 7 companies. So less than 1% makes up for over 33% of the S&P. And these are very volatile stocks, right? Tesla, Meta, Amazon, they move very, very wildly, even Nvidia. So that creates volatility for the aggregate index as well. The top 10 make up for 40%. And this kind of concentration we did not experience 20 years ago, 30 years ago. This has happened over time as these companies have gotten bigger and bigger. So that's why we're seeing higher levels of volatility, intraday swings for the market has become more common than before. Okay, let's see. Yes, but if you entered the market in mid-2025, it doesn't matter much what happened before. Yeah, true. I mean, market timing, nobody can really time the markets well, but our goal isn't to time the markets, but really try to understand where the risk reward is the most favorable. As I've always mentioned, we can never predict where the markets are going. We can only react to whether there is an overreaction. Because that's where the opportunity lives. If the fair value is X and the stock drops X minus 20%, that's the overreaction, that's the opportunity, and that's where the risk reward seems very attractive for us to dollar cost average into. And as I've mentioned this before, everything is worth buying at the right price, right? Doesn't matter what it is. If it's stocks, real estate, gold, silver, a piece of chair, I don't know, like a lamp or TV or whatever, everything is. You can make money on almost everything if given to you at the right price, even that price is $0. So that, holds true because price really determines your future returns. If you pay the right price for the right asset, then you really eliminate a lot of that risk from your chair, not a piece of chair. I was talking about something else. But yes, an actual chair or a piece of anything, for example, but it has value, right? So if given to you at the right price. So anyway, we got 2 more minutes until inflation. So CPI numbers, let's come back. We'll continue our conversation for individual stocks. I'll continue the Q&A after the CPI numbers come out in about 2 minutes here. So we'll take a look at inflation. We'll see how the markets react. We'll filter out the report. We'll just take a look at what's been moving over the last month here in terms of those changes. And then we'll come back to the Q&A for everyone. Fed chair is cheap. Opportunity to buy SoFi cheap AF lasted for years. Time to go up. Yep, it was trading in the low singles for a long time before exploding to the double digits here. And then even Palantir, right? Palantir, SoFi, both record earnings and then dump. Yeah, I mean they had a pretty brutal sell-off. Anyway, so we'll reload this page. You know what? I'll just open up a incognito just to make sure there are no issues. Consumer price index. And we will just open up the PDF as soon as 8:30 a.m. hits. So hope you all are ready. And in about 30 seconds, we will have the CPI numbers for the month of January, and we'll see whether we hit 2.5% or not based on those expectations. I've got the QQQs, I've got the SPY. We'll take a look at gold, silver, Bitcoin, Ethereum, crude oil, dollar index, as well as, what am I missing here? The bond market. So TLT and the 10-year treasuries we'll take a look at as well, just so we cover all assets and all markets. Okay, it is 8:30 a.m. Eastern in New York. Let's see if this PDF file actually opens up. There's sometimes some issues there. And let's see. And we are looking at perfect January 2026, 0.2% is that month over month change. And if you come down, we are seeing inflation come down. All items sitting at 2.4, which is lower than where the expectations were. So headline inflation, CPI sitting at 2.4. And this is the first time we're actually seeing core inflation trade back above headline inflation since September. And of course, we had that October blank because the government shut down. We did not get that report. And core inflation is sitting at 2.5%. So all items sitting at 2.4. Core is sitting at 2.5. Big drops in energy on a year-over-year basis. And even on a month-over-month basis, seeing 3.3, 3.2, 5.7% for energy commodities, gasoline, and fuel oil. Seeing substantial reduction. Used car prices and trucks down 1.8% month-over-month, down 2%. So overall, this report came in better than where the expectations were because both headline and core were expecting 2.5. We got core at 2.5. and we got headline at 2.4 coming in below expectations here for CPI. And a lot of that sell-off coming from energy. Energy saw the biggest reduction of over 3%, 5% on a month-over-month basis. And year-over-year, energy prices are down quite a lot. They're down over 5 to as much as 7% on a year-over-year basis, which is, once again, a pretty substantial reduction on a year-over-year basis there. So there we go. That is the number. 2.4 is where we are for January of 2026. All items as food and energy. So core CPI is now sitting at around 2.5, which is on par with those expectations. And it has continued to trend lower since the peak of 2022. Food prices are also down to 2.1%, and that's food at home. So food prices in general, 2.9%. And this is the big drop here in energy. As you can see, we're back down to negative 0.1%. And energy over here, gasoline, is also negative, down to 7.5%. So big drop compared to same time last year. So reading a little bit further, I'm also curious on where the index is. So the index increased 2.4% over the last 12 months to an index level of 325.252. And that's where we are for the month. Increased 0.4% prior to seasonal adjustments there. So a little bit of a positive reaction, a slight positive development in the S&P and the QQQs here. Volatility opened higher, still trading above 21 right now. Crude oil prices flat so far. If you take a look at the US 10-year treasuries, we are sitting at down 4%. That's where they're sitting from highs of 4.3. They have pulled back a little bit, about 5%. And the dollar index is also stable, not really moving much. And gold prices are pushing up 1%, still a little bit under $5,000 an ounce. And silver is also a little bit under $79 per ounce at the moment. So overall, better than expected. So yes, this is overall good news. I mean, good positive development. But again, we don't know the reality of these numbers. We don't know if these are actual true numbers. But this is all we have. Unless all of us, the 900 people watching, decide to start surveying people and commercial businesses and grocery stores, this is all we have. This is all we can work with to better understand where inflation is. Whether this is true or not is up for the conspiracy theorists. But for us, this is all we have, the numbers. Yeah, it doesn't matter what we think, 100%. Only gold and silver are worth, stocks are doomed. So again, let's just come back to the Q&A. Let's go over some questions here. Kevin, hopefully Ben's underwear prices dropped because, oh my God. All right, so let's see. Any questions? Let's do that Q&A again. Employment is more, look at, than inflation. So yeah, unemployment also came in at 4.4%. So, you know, the good thing is that on paper, things are moving in the right direction. Again, I don't want to be, trying to dissect whether this is real or fake, but on paper, at least, we're getting some good progress. Unemployment is down to 4.4. Inflation is down to 2.4. Very close to the Fed's target, by the way. I think this is the lowest we've been in a long time. So let me just come back to the report here, the chart, and all items are 2.4. We were at 2.3 back in April of 2025. Then we started trending upwards. We got up to 3% again. And then now we're back to 2.4. So again, we're at a lower level, and the lowest level since we've seen since 2021. If you were to exclude for the April 2025 dip. And then all items list food and energy is in fact at its lowest level since March 2021, since right around after COVID. This is the lowest level we've seen for core inflation at 2.5. So I think that's really where the headlines are going to be focusing on. Like, we hit a 4-year low on core inflation at 2.5. We haven't seen 2.5 in this entire dip. So we've just been trending down on a year-over-year basis. So there you go. That's the headline for the markets. Does this mean no rate cuts? So that's a good question. It doesn't mean no rate cuts. It does mean there is a less need for rate cuts if inflation is already trending down. Because if they do start to cut rates, what happens, right? They are injecting a little bit more easy money or liquidity into the economy, and that could risk rising inflation in the future as well. In other words, if people have access to cheaper capital, lower cost of borrowing, then people start spending more, investing more, and that drives up demand, that drives up prices in the future. And so that's one of the risks, but they only lower interest rates if there is a bigger risk of recession or unemployment or labor market getting worse, because I think those fears are very real, especially when you consider the rise of AI, artificial intelligence coming into market has really, taken up jobs, have displaced people in lightning speed. And as a result, we're seeing the biggest job cuts in the US in January since the 2009 financial crisis. And then a lot of, significant decrease in job openings as well. So Joel's numbers have come down from 12, 13, 14 million at one point, that was a high, down to now 6.8. So essentially been cut in half as persons unemployed has been trending upwards as well. So that ratio, which we have talked about in our unemployment videos, has also been coming down. So that is a bigger risk, in my opinion, for the Fed now than inflation. Inflation has also been trending down. Again, whether it's real or not, it's really all we got to analyze. So yes, it does kind of lower the need for rate cuts, but we'll see. We'll see what happens with unemployment, right? Unemployment's been trending down, but these are longer cycles. It's not like we're going to have a answer over one report or two reports. This is all a trend that we have to analyze. And the trend right now is, at least for me, from my reading, is there's a bigger risk to unemployment on the upside, which I don't even know if interest rates can fix. And that's my monetary policy take, right? If I put on the tinfoil hat, I'm just going to say that, we were in a very new technological era where AI is driving productivity gains for a lot of companies, is displacing jobs, but interest rate reduction may not be the right tool to fix this new problem, because new problems do need new solutions. And that is a very new problem that we're dealing with. So I also mentioned that it is my belief that we might be going into a temporary, momentary period where we do see high levels of unemployment and high levels of economic growth and productivity at the same time. As companies become more efficient, they're saving more money, earnings are solid, while also having high levels of unemployment, and job openings are coming down and layoffs are happening at a more rapid pace. So both of these things can be true, and this might be the new economy that we're dealing with. So yeah, Kevin says, fire up the money printer. So Carly says, I'm a retailer, let's be real. Some items are lower or stable and people are buying, but now going more to Walmart than Target. Discretionary may be taking a hit, but people are still buying, yes. Yeah, I mean, that's because credit card debt's also at an all-time high, right? So it's very important to keep that in check, because if delinquency rate starts to rise, that's also one of the early indicators that the U.S. consumer, or consumers anywhere, are starting to feel the pain of inflation, rising cost of living, and of course the unemployment situation. So credit card debt sitting at over $1 trillion now. Interest alone is 25%, which again, we talked about the Credit Card Competition Act. We talked about all the things that, President Trump is trying to pass, trying to reduce the rate from 25 down to 10%. All of those things could help, but at the same time, we cannot ignore that a lot of that lifestyle spending, a lot of credit card spending is what's boosting a lot of that demand, which may or may not be the best way to utilize capital over the long term if delinquencies start to rise. So that really is the big indicator on the credit card side, on the debt side. If delinquencies actually start to scale up, whether that's home loans, mortgage loans, credit card loans, all of that. Okay. Inflation has to reduce as it adds every year, while salaries are not able to keep up with inflation. 100% agree. I think that's another big thing, because wages are not going up as fast as inflation. Inflation, in fact, over the last 5 years has not trended at 2%. It's not even at 2.5% or 3%. It's actually closer to 3.5% and 4% has been the inflation, actual real inflation, if you consider how quickly prices jumped after the pandemic. And we did the analysis on Excel as well. We simply look at the CPI index. That's what you have to really look at, because that's a basket of goods and services, kind of looking at the index value. And as I mentioned earlier, when looking at the report, the index value right now is sitting at 325.25. That's the number, right? At the end of the day, like the percentage year over year is calculated based on the index value. And whatever inflation we do get, that is a year over year number. It's not telling us the total gain over a 3-year, 4-year, 5-year period, right? It's only a 1-year number that we're seeing. So yeah, so that's where we are. And month over month, obviously, is the index value calculated based on the prior month. And if you were to look at the 5-year inflation or 6-year inflation, it's much higher than 2%. So I've mentioned this before. I think long-term investors most certainly cannot be looking at 2% as an inflation figure. I think it's important for us to price in a 3% or 4% inflation when we're doing our financial forecasting, when we're planning our own projections and investment portfolio goals. We have to look at 3% or 3.5% or higher, because I do think that inflation over the long term could be on the rise. 2% is definitely a dream, in my opinion, at this point. Especially for housing. Housing prices go up crazy. Affordability for housing is just insane. 3 rate cuts this year. Chance went up to 50%. Let's take a quick look here. We'll reload this page and see where we are with the FedWatch tool. And if there are 3, if we are looking at CME FedWatch tool here. So if you're looking at 3 rate cuts, I mean, that could really potentially drive up the risk for higher inflation long term as well. So we're looking at 1, 2, and yes, that's January 2027. So right now the probability for rate cuts is still 2 for this year. 1 in June, 1 in September. This 3rd rate cut is January of 2027. So it's not this year, even though it's kind of back and forth here between a pause and a cut, 29.4 and 28.6%. It's kind of flirting in between whether we're going to see a rate pause or a rate cut. But that's also for 2027. Right now, the markets are still only pricing in for 2 rate cuts in 2026. Okay, let's see. Are you buying AMD here or just waiting and see if it pulls back to 185? AMD here is not ideal for me personally. I think somewhere between like under $200 would be a pretty good price. It did come down to 190, but ideally I think my fair value landed around 150s. I could see myself picking up AMD in 170s. And, whenever I talk about these prices, I know the first thing that I get is like, it's too low. It's, we might never see those prices, but time and time again, we see prices come down to those levels. We see corrections, pullbacks, sell-offs happen over time. You just have to be more patient, disciplined, and have a strategy, right? And so for AMD, if my price is 150 and I've got a light buy at 170, I don't mind starting a position at 170, picking up more at 150, and buying a lot at 140. So for example, Microsoft, we're patient. We're very, very patient. It's come down to low 400s already, dipped down to 390s. My fair value is sitting at 350 for Microsoft. So, is it going to come down there? Nobody knows, right? I can't tell you if the price is going to come down to 350 or not, but at least that is my anchor for me to look at. Okay, 350 is a good price for Microsoft. The risk reward is pretty decent, and that's a level that I would feel comfortable adding more or starting a new position into Microsoft. And at that price point, from all-time highs, we'd be down a little bit over 35%, which is pretty substantial for a company like Microsoft. So, with a lot of the analysis, it's really all about putting a fair value with a very conservative analysis and then sticking to it, not getting sucked into the hype, not getting sucked into FOMO or any of those things, because there's a lot of shiny things in the market that you can get distracted with. I'm underwater on SoFi cash secured puts. I sold $26, put expiring on February 20th. I wouldn't mind getting assigned at 22. Where should I roll it to? So, Shrikant, one of the things that I always tell is to never roll a put. There's no benefit to rolling a put, right? Your strike selection, your stock selection, 2 very important things when you are selling a put in the first place. And if you regret picking a wrong strike or a wrong stock, unfortunately, that's something that we need to address first rather than trying to figure out how to get away from it or how to roll it or how to get back out of the money, right? Because if you fix the first problem, then the second problem doesn't even exist or doesn't even happen in the first place. So I've always mentioned if you're selling a put, make sure that the stock you're selling it on is something that you're very confident you want to own long term. And the second thing, the strike. The strike should make you feel comfortable that I actually want to buy that stock at that price. I feel very excited if the price comes down to that level, because rolling a put for me, is a loser's game. It doesn't achieve anything. It doesn't accomplish any benefit. You're just trying to run away from that trade while taking a loss. For me, that's like waste of capital, waste of energy, waste of time. So if you are getting assigned at 26 minus the premium, whatever your cost ends up being, you could start the wheel strategy. You could start selling some calls to collect some premium. But really, strike and stock selection, very important when you're initially selling a put. But in your case, if you do want to roll, make sure that you do it for a net credit, right? You go out a few weeks and see where you can move your strike down to. So it's going to be down and out for that roll. So moving down the strike and out the expiration, and then see what kind of net credit you can get, and then go from there. But always, always, always do for a net credit, right? Never roll for a net debit. Kevin says, never say never. Could you take a look at Intuit and let's see, Arista Network. I'm just going to catch up to all the questions here very quickly. Wait till the market opens and settles before buying Amazon. I'm currently in it and suffering. Amazon's been definitely struggling along with a lot of other tech stocks and software stocks. Don't forget the large-scale immigration deportations this regime has done. Most are legal and no criminal history, according to DHS themselves. What do you think about Intuit and ServiceNow? So I think both, being in the software sector, are hurting. Intuit more so than anything else broke down from this bear flag like crazy, and it's now down 51%. I would look at 350s as the next support for Intuit. So this is what you have to really address for SoFi. For Intuit. So that's going to be that next support at 345, 346. And the other one was ServiceNow, another package software company, absolutely getting destroyed right now. 58, 60%. Next support down in the 80s, $84, $85. So anything inside this green rectangle is going to be that area of support for ServiceNow moving forward. But they're all very oversold. I mean, a lot of them are extremely oversold right now, given the amount of sell-off that we're seeing in these companies. Okay. Check 1 2 3 4. Can you guys hear me? Okay. Can you guys hear me just fine? Okay. I don't know what happened there. I think the stream just dropped off. My OBS studio just kind of crashed for some reason. That's so weird. You are so back. Okay, perfect. I think we are good to go again. Yeah, I don't know what happened. But as I was saying about the REITs and ETF question, I think office REITs definitely something that we may want to reconsider. It's just the category of REITs that you're considering. I think commercial real estate is still going to be fine. And again, segregating that commercial real estate from department stores, convenience stores, grocery stores, like Realty Income Corp as a portfolio of companies like Walgreens, Walmart, Target, discount stores, Dollar General, like all those are fine. But then you also want to avoid like commercial office space REITs, which with the rise of AI, remote work could be under pressure. I think data center REITs are also something to look into. And then American Towers, AMT, is also one to look at as well, because it's been selling off quite aggressively. It is now starting to round out at a support. Decent yield of about 3.6% with a potential for some upside given the sell-off that we're seeing. Can't hear me? Bad audio. Let me see if I can fix it. Check 1 2 3 4. Can you guys hear me now? How is it going? You know what? I'm gonna turn off all of this report since we've already covered it. Apple's honestly like starting to piss me off, because I bought this laptop like literally last year with the best specs, highest specs possible, with like a 24 gigs of RAM, like 1 terabyte, I think, of SSD. Like I bought the highest spec and it still freezes. It still has issues. It's not a Wi-Fi issue, because if the Wi-Fi is extremely strong, my laptop, I've seen problems with my laptop so much in the past. I don't have a mute on. Can you guys hear me though? Kirby, you may want to restart or like refresh your stream, because it should work. I have my audio on and it should be working. So, buy only laptops made in the USA. I mean, this is technically designed in the USA, right? Because when you buy it, it says designed by Apple in California. Only the design part, not the actual manufacturing part, because we know where that happens. Okay, perfect. I think it should be fine now. We should be working. Let's come back to stocks. Let's take a look at Arista Network, because I remember I was talking about ServiceNow and Intuit, and then let's take a look at Arista Network. Huge rallies for Arista since April 2025. I think it more than tripled or quadrupled or something, 170%. And then a little bit of a pullback, support level 120, and now starting to push right back up here. Resistance is going to be closer to 160 for Arista Network. So that is going to be that resistance to watch. Support level is going to stay put at 120. I think overall, Arista is a very, very strong company, phenomenal business. It might be a bit more on the expensive side in terms of valuation. So how often do you shut down and restart your laptop? It needs some rest. I actually never do that. Are you supposed to do that? I always keep it like, when I'm done using, I just put it down. And then when I want to use it, I just pull it back up again. I don't really shut down or restart my computer. Only when it needs updates. That's when I do it. Okay, we can hear you just fine. Okay, perfect. Sound is perfect. Great. What do you think about selling Netflix calls below cost basis given the brutal sell-off? I would see if you can avoid that if possible. If it's absolutely necessary, then yes, of course, go for it. But do it still with a delta of less than 20. Even if the cost is less, or even the strike is less than your cost, I would try to do it with a delta that's 20. Because that still gives you a much higher chance of expiring out of the money. 80% chance that it expires out of the money. But of course, if it does expire in the money, then you know what you are signing up for. So that, I think, is something you have to definitely be okay with. So, okay, let's take a look. Green today or red? Again, nobody has any idea. Nobody knows. Right now we're kind of flat for the market. QQQs are up 15 basis points. SPY up 12 after the inflation number that came out. And right now, nobody really has any idea what kind of day it's going to be. So, any thoughts about memory stocks? Micron, SanDisk, WD. So I think we've done some analysis on Micron for sure. It's been running. I think it's extremely overbought right now. So is SanDisk. There's been shortage. There's been massive demand and excessive shortage in terms of supply. And that's causing these stocks to go up. Like, I think it's quadrupled from $60. It has gone up like over 600-700% since April of last year. So Micron definitely has been one of the bigger winners after the tariff sell-off. Same thing with SanDisk. These companies are very strong, but again, Micron a bit more stable than SanDisk. Valuation has exploded for sure. So 39 times earnings, a little bit over 11 times sales. Earnings expectations are indeed very strong to explode in 2026 to like $33. It's like 4 times or 3 times the earnings than what we just got in 2025. So are you going to finish your position with Hood to start a call soon? Yes. I'm going to be picking up more 50 shares for Robinhood. And the plan is to then sell calls on my position. Most likely in the low 70s. I'm planning to actually pick up today. Low 70s. I'll pick up another 50 shares. And then on the next big green day, which seems like today, I will be looking at selling a call on Robinhood. And then the plan is to pick up Broadcom as well. Need to pick up another 80 shares of Broadcom to round out that position, about 100 shares. And then I will pick up more Palantir because then the plan is to sell calls on all of them. Palantir 100 shares, Robinhood 100 shares, Broadcom 100 shares, Meta 100 shares, Netflix 100 shares. And then those are the ones that will be completed. And then I'll just be selling calls on those positions. NVIDIA will be the core of that portfolio still, 1,000 shares. And then Tesla will keep that at 300 shares. And then SoFi, I need to pick it up to 3,000 Right now, that's about, I think, 2,500. So the plan would be to pick up another 600 shares. Crypto definitely has been struggling. PK Kumar, if you want to refresh your stream, it should work. It should be fine. Meta again. Yeah, Meta is, I think, at the end of this year. So I'm done with that one for now. We'll kind of revisit it towards the end of this year. And then see what I want to do with Meta. But yeah, Bitcoin really is hurting that portfolio right now because I'm down quite a bit on my BITX position. And so like today, for example, I could start selling some calls again. I've got 1,000 shares. The plan is to sell at least 10 calls on the next green day, which might be today on this bounce. But I'm for sure going to have to play with fire here to go with a strike below my cost there. So that is something that we have to address today or next week. Okay, perfect. Palantir price target. There isn't necessarily a price target on Palantir, but there is a buy target, which I mentioned before in my Palantir video, which I encourage everyone to watch, is closer to $80. So that is a level that I'm really watching on Palantir. That is close to my fair value, which again, I might get some pushback that $80 is too low. But as I've said this before, the lower the better. Okay, as investors, it's always a good thing that you want lower prices. If you come to me and tell me, hey, I'm looking at investing in this stock or this piece of real estate, and I want to offer 20% below what they're asking or 20% below the market price, always a good thing. You want to pay the lowest possible price. You want to be as cheap as possible when you're investing. That's how you make money. That's how you actually make sure that you eliminate a lot of that risk. You build that margin of safety, and you your price determines your future returns. So you think we'll see Nvidia go below 170 again? I think depends on a much bigger sell-off. So if you do see, a macro sell-off, like the markets continue to pull down, NASDAQ continues to sell off further, and there is a semiconductor specific sell-off. It really is a hyperscalers game. And semiconductors, I'm going to be bullish on them long term because I know this is where the future is headed. Semiconductors and chips are going to be needed in almost every piece of technology long term. Even things that we don't even know what it's going to look like. But if it does trade below 170, or which is very possible because that is a very strong support, and it's also been range bound, very similar to the S&P, the NASDAQ. Nvidia has also been very range bound. So if it does trade down to 170 or lower, not that I want to pick up more shares because I already have a pretty overexposed position in Nvidia. I could see myself picking up maybe more shares in the 160 or 150s. I did a video on Nvidia recently. Or no, Nvidia hasn't reported earnings, but I think I did like a very quick analysis and I think it came out to like 120s, I think, the fair value. 120s or like 125 or something. Juan, do you generally prefer entering the wheel by DCing on the way down instead of selling puts? So it's both. It really is, sometimes I do a buy right. Sometimes I would sell a put. Sometimes I would just buy the stock straight up and DCA slowly. It's a mix of both. But my go-to strategy would probably be starting a small position, dollar cost averaging a little bit slowly as the stock's coming down, and then selling calls on the way up. That's worked out really well. But then also starting the wheel with selling a put first and then selling calls consistently. As I mentioned before, in the world of options, you make more money on capital gains than you would do in premiums any day of the week. Premiums are there to generate some good income that you can reinvest back into more shares, but capital gains is really where a lot of that money is made. Stock going higher, prices appreciating. That's why rolling a call is more lucrative, more beneficial to rolling a put, because you want to keep your ownership of the stock while generating income, while also capturing the upside. So it's the best of all worlds is why we try to roll calls as much as possible. So, okay, let's see. Holding 600 shares of BITX 1850, waiting to sell calls at $19 and $20. That's a great average, by the way. That's a very good price for BITX 1850. I wish I had that price. But BITX has really crushed over the last few weeks here as crypto has just taken a huge dip. So as BMNR, so as a lot of these names, right? They're just all hurting right now. So Bitcoin now 67,000. let's do another poll. Has Bitcoin bottomed? Crypto bottomed? Let's just do this. Last 2 times we did this poll, and both times we had a majority that crypto has not yet bottomed. Okay. Let's see. We got over 600 people watching, and I'm curious what everyone has to say about crypto. Has crypto bottomed? Have we already seen the bottom for Bitcoin and Ethereum right now? Spare a little thoughts for Tom Lee. Tom Lee said it's bottomed, so it's going lower. I honestly, I shouldn't even be doing this poll because I don't want to give you guys the wrong idea, but I don't think price predictions, bottom predictions are useful at all. I do it for fun. Obviously, this keeps the live stream engaging. It's a good thing to kind of understand, okay, where's the sentiment right now? But I would not, and I would encourage for you the same, take it with a grain of salt, right? Take it with a grain of salt. Any kind of price predictions, any kind of bottom predictions, take it with a grain of salt. Even if 75% people right now think that, crypto has not bottomed, take it with a grain of salt, right? Because nobody really knows. At the end of the day, these are all speculations. These are all predictions based on no evidence or no basis or no calculations. And as a result, it's not useful, but it's fun. That's all it is. It's fun, but it's not useful. So just enjoy it, laugh it out, but we cannot make decisions off of it for sure. So yeah, same thing. I would spare my thoughts on Tom Lee as well. I think price predictions and bottom predictions just never work long term. But it's useful for people that want to hear what they want to hear, right? Because, I had a finance professor back in college, university, and, he told me one thing, very first day of lecture, and it was very interesting. I've shared the story before, but for some of our newer members, he told me how financial advisors work. You've got a room full of 100 people, and you tell half the people the market's going up, the other half the market's going down. The next day, 50 people are going to believe that you're a genius. Then you tell 25 people the markets are going up, another 25 the markets are going down the next day. Another 25 people are going to think, wow, you're right, 2 for 2. And then you tell 12 people markets are going up, the other 12 the markets are going down. And the next day, for 3 times in a row, you are right for those 12 people. And then you start charging insane money to those 12 people for your price predictions. So that is how crazy price predictions can be. It can be either a hit or a miss. So BITX versus BMNR for long-term gains. I would prefer BITX because of the lack of share dilution, but it's also a bit more leveraged. It's a bit more volatile. For Ethereum, I would be looking at ETHE or ETHU. Those are Ethereum ETFs. BMNR has a very different kind of proposition, right? If you're looking for Ethereum exposure, you might want to go directly for Ethereum, but BMNR has other value adds, like with Mr. Beast and other sort of moonshots, as Tom Lee likes to call it, because even though they're an Ethereum reserve, they want to be investing in other projects that they think are going to be good for shareholders long term. So you're not getting anything different than what you'd get from, let's say, a MicroStrategy, which is also a Bitcoin reserve, but Ethereum reserve for BMNR is just doing a little bit of extra with their creative investing, with moonshots and so on and so forth. So can you please show how to find your technical graphs? Yeah, so we have links on our Discord. So on Discord, I have all the links for my charts. So whenever you click on them, it'll take you exactly to this page. You can filter different stocks and you can look at my analysis live. It's all synced, it's all automatic, and it's available on Discord with all the links there. All right, everyone. So that is going to be it for today. Inflation numbers came out a little bit better than where the expectations were. Markets did get a very temporary spike, and right now we're very, very flat at the moment pre-market. Thank you so much for joining. My parents are still here. I'm going to be spending time with them for the next couple of days, and then next week I'm back with live streams every single day, and of course with everything else on Discord as well. Thank you so much. I really appreciate you all. Take care. Have a great weekend, and I will see you all in the next live stream. Take care.